So, good evening, everyone. I am Amit Kumar, your host this evening, and I'm management trainee at Adobe. Before we dive in, let me give you a quick glimpse into Adore. So, Adore is a global network of students and young professionals like yourselves, all passionate about inspiring youth to make a positive impact. We connect you with established professionals and offer a platform to learn from their journeys. Now, on behalf of Team Pyramid and Adore, we are thrilled to welcome you to this webinar on the uh, webinar on the basics of investment. To make this session even more engaging, we kindly request everyone to switch on their cameras. So, yeah, thank you guys. And now, the moment we all have been waiting for. Our estimated guest speakers for tonight are Mr. Philip and Mr. Eliza. Philip studies finance at Monash University, has experience in private equity, and is currently pursuing his CFA level CFA level 1 certification. And Alia studies law and commerce at Monash University, serves as a sponsorship director for a university network of investment and traders, and is pursuing his CFA level 1 certification. Now, Mr. Philip and Mr. Aliha, it's a true honor to have you with us today. We all are eager to gain valuable insight from your expertise. So, Mr. Philip and Mr. Aliha, the floor is all yours.
Thank you very much, Amit. So, as you just said, I'm Elijah Briggs, and this is Philip Reynolds, and we're here today from the Australian Financial Literacy Foundation, or the AFLF. So, just to tell you a bit about us and what we do. So, we strongly believe that our goal is to inspire everyone to take control of their personal finances and to consider careers in finance, thus broadening their horizons. We believe that with opportunity, every single person can achieve greatness, and helping people like you reach these goals is what drives our mission. So, just to discuss what's on the agenda for today. So, we'll be beginning with what are investments and why do we need them? And we'll pivot on to the power of compounding, so how compounding works and how we can use it to generate a stable retirement fund. Then we'll move on to the different types of asset classes used for investing, so real estate, bonds, alternative investments, and in stocks. Then we'll follow that up with a breakdown of what's called the efficient market hypothesis, which you'll find out more about later. And finally, we'll pivot on to reasonable returns and what can be expected as a general investment return. So let's start with, well, what are investments? So simply put, investments are a method of bringing your money into the future at a higher value than it is currently. Now, there are many, many different types of investment vehicles to accomplish this goal, far more than we could discuss in one session. Now, what vehicle works for you will depend on what your level of risk appetite is, so what level of risk you're comfortable with, and how much risk you are actually able to take, otherwise known as your risk tolerance. So, why do we need to invest? Why is it important that we grow our money into the future? I mean, couldn't we just all have our money in cash and put it under our mattress and use it when a rainy day comes? I mean, look, absolutely we could. However, money loses its value. Now, how does this work? So, we think about the year 1924, it's exactly 100 years ago from today. A new house cost $7,720. And a new car also only costs $265 using USD. But if we look at now, a new house is $420,000 and a new car is $47,000. And this comes as a result of inflation, so money literally becomes worth less over time. Therefore, it is absolutely essential that we bring our money into the future at a higher value than what it is today, as things become more expensive. So, the most important factor in this is compounding, or the value of time, the amount of time we can be investing for. Now, the longer we're in the market, the more money we will have. Now, why is this the case? Well, let's say, for example, I give you 10 cents that doubles every day for 30 days. How much do you guys think you would have at the end? $1,000, 10,000, a million, maybe 10 million? Actually, more than that. The answer is $107 million. Now, it's obviously not realistic that you can double your money every day for 30 days because, well, otherwise everyone would do it. But it does go to show that with enough time in the market and consistent returns, we can generate very, very large sums of money over a long period of time. Now, the other important factor of this is compounding frequency. Now, for another example, let's say that I give you $100 that earns 10% return per annum, $10 a year. Will it matter how often that 10% is compounded? Well, a short answer, yes, it absolutely does. So if we compound it at the end of each year, we would have $259.37. Whereas if we compounded it at the end of every day, we broke down our 10% into a daily rate, so divided by 365, we would have $271.79. Now, this doesn't seem like much, but in percentage terms, this is about a 12% difference. Now, if you had $10,000, that would be a $1,200 difference. If you had $100,000, that would be a $12,000 difference. So as we've seen previously with compounding, as the amount gets bigger and bigger, the frequency we compound at becomes more and more and more important. So transitioning over to real estate.
I'll be covering the different asset classes. Firstly, real estate. Real estate is, of course, a tangible asset. You can live in it. It's quite safe. However, it requires substantial upfront deposits and costs. And often people don't have this money, so they get a mortgage. What's a mortgage? A mortgage, easily explained, it's a loan from a bank that is comprised of payments that one service the initial amount the bank loaned to you and to the interest you're paying, which is what the bank charges you for the risk they're taking to give out the money to you. So it's important to note that the more quickly you pay off the mortgage, the less interest you have to pay, therefore the more principal you're serving, so you're ahead net. And of course, given the safety of the asset class, the approximate returns are lower at only 8%. Now we can do a live demonstration on actually mortgage financing rates by sharing on the second screen. So if we wanted to borrow $200,000 at going interest 6%, with, I mean, average mortgage rates are about 25 to 35 years, so 30 years is fine length, then you can see that of the $200,000 principal, you're actually paying $231,000 over the lifetime of the mortgage. That's just interest. So it's not servicing the money you actually lent. So that goes to show that the quicker you pay off, the less interest you have to pay. And of course, you can change that with your payment frequency to where slower repayment is, of course, not desired. Because then you pay more. I think the calculation on the website should be bigger, the difference. Anyways.
Share this screen.
You stop sharing. Back to the. All right. Then there's 4 types of real estate. So you have residential properties, which is what you'd be in right now, which it comprises of single family homes, apartments, or condos. Then we have commercial property, which is the second biggest class, which would be office buildings, retail spaces, or warehouses. Now, during COVID, of course, the demand for office spaces has starkly decreased. The supply is still there. So commercial real estate has actually gone down in value significantly. Even though we're now 4 years out of COVID, it's still heavily depreciated. And then third, we've got industrial properties, which are properties that are actually producing assets. So factories and storage units. And then lastly, it's just land, so undeveloped land, just a bit of earth, or agricultural land in the shape of farms and such. Talking about the benefits and drawbacks of real estate. So of course, the benefits are your rental income, steady stream of revenue, very easy to calculate. Your capital appreciation, which is typically land is of course finite. So with growing population, the demand for housing and land increases. So over 10 years, 20 years, you can of course sell that land for a premium. And thirdly, governments want to subsidize, of course, home ownership. So often personal mortgages are tax deductible, so your tax impact goes down. So actually a mortgage or real estate is therefore subsidized by the government. And of course, it's a tangible asset that you can live in or rent out. It's real, you can see it. However, the drawbacks are extremely high capital costs, very intensive, capital intensive. And of course, there's ongoing property maintenance, upkeep, etc. And also, if you were to rent out your property, you have to make sure, of course, that you have a tenant, and that, of course, is time consuming and comes with its own set of problems. And even real estate, of course, subject to market fluctuations. So it's, of course, ideal that you don't buy at extremely expensive times, because, of course, real estate changes very slowly and you don't want to be caught on the downside. And lastly, a big drawback is, of course, illiquidity. We will expand more on the concept of liquidity and illiquidity, but essentially it just means that if you were to invest, say, $100,000 and you need $10,000, you couldn't easily get those $10,000 back because they're in the asset. Whereas with stocks, for example, you could sell that fraction. Taking a closer look at the example of a real estate asset. So the following parameters are: we have a 5-year time span, and let's assume we're buying a property worth $200,000. And let's assume that property generates a rental income of $1,000 per month. And let's say at the end of 5 years, we can sell said property for $250,000 US. So $1,000 a month times 12 months is, of course, $12,000 per annum, times 5 annums, because it's 5 years. That would equate to total rental income of $60,000 and capital appreciation of $50,000. So the total revenue would be $110,000 over this 5-year span. Now, as Elijah previously explained, money has time value. That means those 110,000 in 5 years are worth less today because you have to discount them, because first of all, you need to be paid for the risk and the time. So discounting that over 5% for 5 years, the present value of this said opportunity of a $200,000 asset would be $86,187.88. And that would equate to about 8.6% return per annum, or almost 9%, which is, of course, on track with what you would typically expect with real estate return-wise. Moving on to the next asset class, and considered amongst the safest, or not the safest asset class, we have bonds or debt. What are bonds? Bonds are loans made by investors to borrowers. Now, these borrowers tend to be either corporations or governments. And in exchange, so of course, they ask money for you, they need fundraising. So let's say a company needs, say, $100,000. Then they would consider raising 100 bonds with a face value of $1,000. That means you would be putting up $1,000 for, say, a maturity of 10 years. At the end of these 10 years, you get your $1,000 back. And for exchange of lending this money, they will pay you interest in the form of coupons. So the key features are, of course, the face value, which is what you're lending and what you're getting back at the end of the contract. Contract time we call the maturity length. So when does this contract mature, come to a conclusion? And then, of course, it's important, what are they willing to pay in exchange for you giving this money? That's what we call the coupon rate, which is the interest that the borrower is paying to you. And lastly, the yield to maturity, which would be your rate of return as a holder of said bond. So, for example, let's say the US government would need to raise money, then they would probably look into raising some government debt. Now, the likelihood of default, or that you're not getting your money back from the government, is extremely low. Therefore, the interest the government would be willing to pay you as a lender would be proportionately lower to, say, a higher risk institution like a corporation. So right now, the going rate for a government bond, a US government bond, would be about 4.5% per year. So significantly lower than the real estate example, but also significantly safer and more stable. So bond prices. There's 3 main terms that we have to consider when talking about bond prices, which is par, discount, and premium. What does that mean? So we've previously discussed the face value of $1,000. So if a company issues a bond of $1,000 and then it trades on the market below that price. So let's say you can buy that bond in the secondary market, someone bought it and is willing to sell it to you for less than $1,000, then it's going at a discount. And if someone would be willing to pay more than $1,000, that bond is trading at a premium. And if it's exactly $1,000, it will be considered on par. What drives these three key components. So bond values are almost solely driven by the current interest rate, the current market rate you could get. So if the government or the corporation were to issue a new bond today, would they pay you more or less? This is at first confusing, but what does this mean? This means if the rate goes up, so if the company issues a new bond and the rate is high, then the value of your old bond goes down because, of course, your asset is worth less than the new assets coming on the market. Conversely, if the lending rate goes down, your asset goes up in value because you secured, of course, the contract at a more favorable rate. So people would be willing to pay a premium for that bond or a discount, depending on the current interest rate. To the right is, I think it's somewhat clear with increasing in interest rate, prices go down, decreasing in interest rate, prices go up. And of course, feel free to ask questions later on this. Taking a closer look at this, what is a discount bond? So as previously stated, it's trading at below its par value. So let's say here, in this case, I should say it's trading at $1,000 face value, is trading at $950 market rate. And the maturity, time to maturity, that means the time at which you get your $1,000 back would be in 9 years. And in exchange over this 9-year period, they are paying you 10% per annum for you lending this money. So at the right, it'd be easier to see. So at the end of the 9 years, you get back your $1,000. In the first year, of course, you pay negative $950. And over these 9 years, you get 10% per year. Now it's notable that bonds typically pay a coupon twice a year. So a 10% on the $1,000 would be $100. And then, of course, divided by 2 would be 50 because you get payments twice a year. That means the coupon would be $50, but the coupon rate would be 10%. So you're getting $50 twice a year over 9 years, which would be 18 times 50, which would be $900 worth of coupon revenue, plus the $1,000 face value you get back at year 9. That means your total revenue would be $1,900. Now, as previously learned, of course, the $1,900 in year 9 are worth less than today. But because we've paid less for this asset, our yield goes up. So if we calculate the yield of paying $950 for $1,900 worth of revenue, we get 10.89% yield per year, or almost 11%. Conversely, let's look at a premium bond. The parameters are exactly the same, 10% coupon rate, $1,000 face value, 9 years left to maturity. But this time we paid over the face value. So $1,000.50. In this case, our yield goes down. If you pay more for the same terms and conditions, of course, you would expect your rate of return to go down. So in this case, it's only 9.17%. In the case, if you had paid $1,000 for $1,000 with a 10% rate, you get your 10%. Now, introducing some set of alternative asset classes. Now, over the last 30 years, a very, very big asset class has been private equity, which offers exposure to things that little small investors like you and I typically don't have access to. It's almost purely for institutions, which means governments or university endowments that have billions of dollars to invest. They would give a couple $100 million to a private equity company. That money would be locked up there for 10 years, and they would buy infrastructure. Maybe they'd build bridges, toll roads, power plants, power stations, or more common, they might buy out a public company, change it, take it private, make it more efficient, and then make it public again. And in that process, you can typically generate outsized returns, which makes private equity a very attractive asset class for large endowments. But of course, the risk with these types of ventures are, of course, also higher than in the aforementioned real estate and bonds. Now, another subsection of private equity technically, but it deserves its own tab, would be venture capital. Now, this brings the unique property of purely investing in early stage, high growth companies, which would be startups essentially. So imagine 3 years ago, Sam Altman from OpenAI had said, oh, look, I need $100,000. And you'd given him those $100,000 because you did some due diligence. You think, oh, this guy is smart, this company is going places. Then, of course, you'd make exceptional returns. However, there's also high risk attached because most startups, as you would know, do not work out well and fail. So of course, high risk, but it's a fun and very exciting field. Next to that, cryptocurrencies are also considered an alternative asset class. I'm sure a lot of you have maybe dealt with cryptocurrencies to a degree, with the two major ones being Bitcoin and Ethereum, maybe some alt meme coins like a Dogecoin or such. Cryptocurrencies or also crypto assets, maybe as like NFTs. They're literally just proof of ownerships using a blockchain network. Quite honestly, I think maybe some of you know more about that than myself, but they're, of course, they bring their own set of risk, which is technical risk, regulatory risk, maybe some set of security risk. And therefore, these assets are, of course, very volatile and less embraced by institutional investors, at least at this stage, but therefore also having higher return potential. Lastly, it's notable maybe collectibles such as art, wine, classic cars, or stamps. Now, art is pretty much impossible to value. It's literally just driven by scarcity and what is someone willing to pay for it. Say maybe for an old Porsche, you know, so oh, I really like that, I'll pay more for that. So people like to hold art or cars or wine as a hedge to make sure that their money keeps value. Going into the arguably most important asset class, stocks. Now, stocks have, of course, been very big in the culture. In many movies you might have seen or might have not seen, like The Big Short, Margin Call, Wall Street, The Wolf of Wall Street, all of which are recommendations if you haven't seen them. Stocks are an ownership stake in a company. So let's say any company, ABC Corp, whatever, were to issue 50 shares for 50% of the company. That means if you hold 1 share, you own 1% of the company. Let's assume someone owns 10 shares, he would own 10% of that company. What does that mean? It would mean you have 10% of the voting rights. That means you'd be entitled to 10% of the dividends, the expected dividends, which are earnings the company would pay out to its shareholders, or expected earnings. Some companies don't pay dividends yet. Now, of course, stocks are riskier than the aforementioned assets, and we'll delve into that as well. How do stocks generate return? So the two ways you get returns on stocks is firstly, capital appreciation and dividends. So dividends I just touched upon. That is the portion of the earnings that is distributed to shareholders that you would be entitled to. So it's just regular income. And of course, capital appreciation was just like in real estate. Say you buy a stock today for $100. A week from now, it's worth 110. You sell it. Those $10, that would be your capital appreciation. Of course, that would be a net gain in money. And or if you own a stock and you pay $100 for it, say it pays a dividend next week of $3, then of course those $3 would be revenue, and then you still own the stock and can sell that at a later date for a profit or a loss, depending on the quality of the investment. So of course, there's fantastic investments. Many might not know that Monster Beverages is actually the highest performing stock of the last 25 years, I think. So since the IPO, so since going public on the stock exchange, their net return would be 69,000% or almost 69,000%, which would mean $1 invested in the IPO is worth almost $700. Or if you invested $100, you'd almost have $70,000. It can, of course, go wrong, like in the case of the Chinese property developer Evergrande, where just supply outstripped demand. There was a lot of property developers. They were very debt fueled. That means they had a lot of risk attached to them. And after people stopped buying Chinese property, of course, they defaulted on their debt and went down. But you can also make money on stocks going down, which introduces short selling. Short selling also somewhat popular and culturally popular and relevant. So what does this actually mean? What a very basic example of short selling be? So let's say your friend has, or him, Elijah, he gives me his new iPhone for 1 year, and he says, at the end of the year, you have to give me a new iPhone back. And since we know technology goes down in price, I say, oh, this is easy. He gives me the phone, I sell it immediately for $1,000. And then say in month 11, so a month before I have to give it back, I'm like, oh, I should buy one back. And maybe the market rate is $800 for a new iPhone, or that one he was lending to me. I buy the same model, and then I say, here, Elijah, here's your phone back. And the difference during this depreciation is, of course, I get to keep. He gives me an asset, I sell it for 1,000, then I buy it back for 800 and return it to him, which is the difference I keep. However, we do not condone short selling. It's of course one of the most risky assets, the most risky things you can do in the stock market, because say, what if the factory shut, no more iPhones, all of a sudden iPhones cost $5,000, but I have a contract, I have to give it back to Elijah. So therefore I'd have to buy one in the open market for $5,000 and give it back, which would be minus 500% losses. So more than my initial investment. So it's very, very risky. Delving into the pros and cons of stocks, of course, high potential returns, probably the highest out of any asset class, but debatable. It offers a great amount of liquidity, which will be further expanded upon. So say if you have a $10,000 investment in Apple, but you need $1,000 now, then you can just sell $1,000 worth of shares and of course still have the rest invested. So you can only sell a fraction, easy, and it's readily available. Of course, they also give you voting rights, which is the potential to influence the company's decision, which there's actually a whole investor class dedicated to this, which would be activist investors, where they try and get control of a company that might be not well run, and then say, look, we'll vote to get a new CEO or something, and then restart the company and get it on the right track again. So activist investing is a massive field that takes that uses the voting rights of shares, of course. Then you're entitled to your dividends, aforementioned dividends. And of course, stocks make it extremely easy to diversify your portfolio because it's cheap to buy many different companies, which of course lowers the risk, which will also be touched upon later. Now, what are the drawbacks? Now, of course, probably highest returns, but also probably highest risk and great exposure to market volatility. So prices fluctuate wildly, especially in the short term. You have the risk of loss. Your principal is not protected. Bonds, for example, your principal would be protected. Real estate, you technically still have a real house, so loss of principal. And of course, stocks require an amount of research, monitoring, due diligence, because even if you were to get your due diligence on a company perfectly right, maybe the economy does bad, market news is bad, and then all stock values go down. So you need to stay informed about market trends and of course your portfolio, the companies you invested in, the company's performance. And of course, there are no guaranteed returns. You could get your thesis correctly, you could invest in the correct company. If no one else sees it, the stock might not go up. Like it doesn't have to. So uncertainty in returns, it most often does though. Then what are the costs associated with stocks or equities? We've got direct and indirect costs. What does direct mean? That means you're actually paying it out of pocket. Brokerage costs or commission costs, which is a fee you're paying to execute trades. There's flat fees and percentage-based fees. Flat fees would be, say you have to pay 10 cents per trade. Percentage would be a percentage of the trade value. Now the indirect costs are arguably more important, but only for large institutional investors who really have many millions to invest. And what's important for them? The bid-ask spread. What's the bid-ask spread? Bid-ask spread is the difference between the highest price someone is willing to buy or bid for a stock and the lowest price a seller is willing to accept or ask for the stock. Now, what does it mean when the spread is very narrow? That means that the price is very efficient because the buyers and the seller are in agreement about the true value of the company. And it also means it's very liquid. So there's a lot of stocks moving back and forth, which means it's very easy for you to buy and sell the company. And liquidity, as a general definition, it's the ability to buy or sell a stock without significantly altering its price.
Beautifully said, Philip. Now, so how do we know what stocks to pick? Now, some may suggest that picking a company you believe in their premise, you believe in their business operations, and then performing extensive due diligence on said company could break the puzzle. However, when we look at investment funds whose goal is to specifically beat the market, we can see that less than 10% of those funds actually accomplish this goal. And these funds simply have some of the best and brightest minds in finance, and even they can't do it. So, why is this? So, for some examples of some investors who have and haven't beaten the market, first we'll look at Chris Camillo, who made $42 million trading stocks over 15 years, and he started with only 10,000. Whereas we can also look at the popular forum Wall Street Bets, maybe some of you have heard of it, where people lost over $700,000 after making a lot of money, but unfortunately they couldn't get their timing right and lost all of it. So what are the reasons for this? Well, first reason is diversification. Now, what's the meaning of diversification? Well, it basically just means instead of putting your money all into one thing, putting all of your money into Apple or Microsoft or Nvidia, diversification refers to actually investing in multiple asset classes, such as different stocks, bonds, real estate, and cash equivalents. And the aim of this strategy is to reduce the overall risk in your investment portfolio. And this has been empirically proven quite a number of times. And if you look at the graph on the right, we can see that as you put more and more different types of shares in your portfolio, the amount of risk that's associated with individual companies starts to go down. Therefore, we can conclude that diversification is fundamental to managing your risk, and we can use it to potentially enhance our returns relative to our risk in our portfolio by essentially spreading our money around. As I always say, you never want to put all your eggs in one basket. You want to put them in multiple baskets. Now, the other reason this may happen, why people struggle to beat the market, is what's called the efficient market hypothesis. Now, the basics of this hypothesis is that if all information is accounted for in the market, it's priced into the stocks, investors cannot make what's referred to as abnormal returns by actively trading. Now, what are abnormal returns? Well, abnormal returns is just the difference between the expected returns, which we'll discuss in the next slide, as opposed to the observed returns, which is just what we actually see. Therefore, based on this hypothesis, abnormal return should equal zero, return should be as expected, and there will be no benefit to actively trading stocks. Hence the underperformance as opposed to a market we've seen from all those professional funds. So how do we estimate returns? What's the expected return? How do we price that? Well, a common industry standard approach, and there are other approaches with more variables and more parameters, but the most common is a capital asset pricing model, or in industry terms, CAPM. Now, this model is used to determine the expected return on an investment, considering its risk relative to the market. So the formula itself is that the expected return is equal to the risk-free rate plus the beta times what's called a market risk premium, which is the difference between the market return and the risk-free rate. So defining each of these terms, firstly, the risk-free rate just refers to the rate of return that can be generated with little to no risk. Referring back to Philip's early example, 10-year government bonds, 4.5%. This would be a good estimate of our risk-free rate. We can get 4.5% a year without incurring any risk essentially on our part, unless the US government were to default, which not very likely. The next parameter is the beta, which is just a measure of a stock's volatility relative to the market. And then the expected market return just refers to the amount that can be earned using a market proxy. So say the amount that can be earned by investing in the S&P 500, the top 500 stocks in the US market. Now, looking a bit more at beta, we can see that a beta of 1 means the stock moves perfectly in line with the market. It's exactly as volatile as a market, which is just the market portfolio, the S&P 500. A beta of less than 1 means the stock is less volatile than the market. So if the market moves a lot, the stock will move a bit less than that. And then a beta of more than 1, so the stock is more volatile than the market. So if the stock moves, if the market moves, the stock will move even more. And then when we put this all back into our original formula, we can see that a higher beta means a higher expected return. This makes sense. But taking on more risk, we would want more return. I mean, who would take less money for more risk? That makes a lot of sense. Now, for an example, let's think of a stock market like a large crowd of people trying to guess the number of jelly beans in a jar. Like a big number, 10,000, 100,000, 1 million. There's bigger numbers you can think of. Now, the likelihood is that each guess will be a little bit off, right? You know, some people will be 1 off, 10 off, 100 off, whatever. But if we were to take the average of all the guesses, it should converge to a number that's pretty close to the accurate amount, given these large sample sizes. Stock market's the same. Individual investors might not and often don't get it right every time. However, collectively, assets do tend to be priced accurately once we account for the extremely large number of participants in a market in general. So now we've got all this information, we understand diversification, we understand the efficient market hypothesis, we understand how hard it is to beat the market. How can we get the returns of a market? Well, this is done through ETFs. Now, what are ETFs? Well, ETF refers to an exchange-traded fund. And what is this? Well, this is basically a basket of different stocks that typically emulate the market or a given sector in exchange for what is a marginal fee, typically offered by BlackRock, big institutional banks, what have you. Now, for an example of this, the S&P 500 index that's offered by many, many firms tends to average around a 10% return over the past 20 years. Again, 10% doesn't seem like a lot. We just mentioned 2 times return early in the seminar. However, this equates to 6.5 times in your initial investment over that 20-year period. So if you invest $10,000, well, good for you, you've got $65,000. And obviously they offer very easy diversification, as previously mentioned. And just for some more benefits of investing in this basket of stocks or ETF, firstly, you don't miss the winners. So you capture what's called the market leaders. So if you invest in this basket of stocks, you are likely to own shares in companies that lead the market. So let's take NVIDIA, for example. NVIDIA's had a great year this year, fueled by the AI revolution. Now, if you invest in the S&P 500, even if NVIDIA wasn't in the 500 biggest companies, by now it would be, and therefore you'd be capturing the growth of that stock within your overall portfolio. And on the other side, if stocks underperform, this underperformance is compensated for by the strong performance of other stocks. I've also, as previously mentioned, risk mitigation. So by holding a large variety of stocks, you're not held at the mercy of the volatility of any singular stock. And we can also get sector diversification. So we can be exposed to medical stocks, tech stocks, infrastructure, all different types of stocks that represent all different types of companies to get exposure to a large range of things. Thirdly, there's consistent performance. As previously mentioned, you smooth out the volatility, as a diversified basket of stocks tends to be less volatile in terms of short-term price movement than individual stocks. And obviously, over the long run, we want consistency. We want that efficient 8, 10, 12% per year. And so lastly, convenience. So buying ETFs that includes, 500 stocks is far, far easier from a practical perspective than buying 500 stocks individually. And also just from a cost perspective, if you were buying 500 stocks individually, you'd have to pay a transaction fee for every single stock, which are obviously unnecessary costs. And just for a bit of a visual illustration, so if we look at cash, which is just representative of inflation in this example, we can see that $100 cash from 1970 would be worth $956 today in terms of what it can purchase. If you invested at 100 in real estate, you'd have $1,500 today. 10-year treasury bonds, 2,286. Gold at 5,545. Corporate bonds, $7,775. And nearly 3 times that amount is the S&P 500 index, what we just spoke about, which has outperformed corporate bonds by almost 3 times. This is a big difference, right? I mean, think about this if it was your pension. So with all of this in mind, now that we understand the power of compounding, we understand the principles of good investments, we understand the risks of individual stocks versus holding the market, we can see that there is no need to seek excessive risk to achieve high returns. We can just take stable risk over a long enough period of time. And most often firms that do claim to offer unreasonably high returns fall short of their benchmark. So we're thinking 20, 25, 30%. It's not sustainable. And then oftentimes historical returns are altered and inflated to paint the most favorable pictures using data manipulation. Or in some very, very bad cases, they're actually scammers. They take your money and they essentially waste it. Now, referring to another live demo to finish off, let's look at a compound interest calculator. Now, let's say with an initial deposit of $10,000. You've worked hard, you've saved all your money, you've scrimped, you've got $10,000 to invest. Now, after that, you're going to invest 100 every single week from your working income, and you're going to get, let's say, less than the S&P 500 that we just spoke about, 8%. We're going to be conservative, right? And let's say you started this at 20 and you want to retire at 60, you're in the market for 40 years. How much money do you think you would have? 500,000, that would be a lot, right? It's much, much more than this. It's actually 1,755,000. Now, these returns are drastically amplified when we change the annual interest rate. Let's say we do get 10%, the next 20 years is the same. What would we have? Well, wow, we'd have an extra $1.7 million. I mean, that's big money. Buy a house on the water, enjoy your life, right? But even if we do change back to 8% and we change initial deposit to only $100, you've saved nothing. We can see, yeah, you lose a bit of money, about $200,000, but I mean, would any of us be complaining about $1.5 million? I wouldn't. Phil, would you?
No.
Not at all, right? Pretty good. And even, you want to retire early. You want to retire at 50 years old. You've had enough of a corporate grind. Well, let's see. still $650,000. It's pretty good for a $100 deposit, $100 a week. Buy less food out. It's a pretty good return. Pretty good. And just switching back to the presentation.
And then, of course, we have a Q&A. We have our emails, respective emails, if you have additional questions to either myself or Elijah. And we have some other useful recommendations for resources, which is namely how the economic machine works if you're more interested to learn purely about economics, or if it's more general finance and company valuations, everything you need to know about finance, with Ray Dalio and Bill Ackman both being very esteemed and respected hedge fund investors.
Believe me, if anyone knows anything about finance, it's these guys. So thank you everyone for listening. And now we'll transition over to questions. So just unmute your mic and I will happily answer any of your concerns.
Thank you. Thank you, Eliza and Mr. Philip, for sharing such an informative presentation. Now, we would like to open the floor to questions, and I request the participants to submit their doubts and questions in the chat box, and Mr. Philip and Mr. Eliza will answer them accordingly. So please go ahead.
Yeah, we're very eager to answer your questions. So best asset to invest in for students. Well, look, as previously mentioned, your risk appetite and your risk tolerance will differ on an individual level. Some of you may just go, you know what, let's let it ride. Let's try and make as much as possible, in which case more risky investments. But on the whole, I would say a diversified ETF investing in the S&P 500 has been proven time and time again to be the best. I mean, as we saw, $100 a week for 40 years when you retire, $1.5 million, it's great income. I think that would be sufficient for any of us.
Yeah, then of course, why is diversification important when investing? Well, it's of course, again, going back to your risk tolerance, individual risk tolerance. So if you're only investing in one company, you've not got to make sure that one company is not fraudulent, it's not going to go under. And also, you don't only have to not lose your money, but ideally you want to beat the market to actually make a lot of money. So if you're investing in only one company, you're just assuming so much risk. Thank you, Elijah, for putting this slide up, because we can see here the company, the blue line, which would be your portfolio risk. So assuming one stock, your risk will be all the way over here. So of course you could do it, but it's like not very recommended. And just by having 10 stocks, you're still higher on the risk level and probably also higher on the expected return level, depending on the shares you decide to buy. But of course, that's why diversifying is probably some of the most important thing you can do.
Yep. So next question. What are the best assets to invest in, which, along with investment benefits, also provide tax benefits? Look, with this question, it's highly dependent on what country you're living in, because different countries obviously have different tax codes. So where Philip and I are from, which is from Australia, we've got what's called franking credits, which means stocks that pay dividends are very beneficial because you can get the amount of tax a company paid on that income initially off of your income tax from those dividends. Property is a very, very good one. In a lot of countries, you've got what's called negative gearing. So if I buy a property and my mortgage is $500 a week, and I rent it out for $400 a week, and I'm losing $100 a week, I can get that $100 a week off my taxes. So it means I'll get my rental loss off of my taxes, but I'll also still be getting capital gains. So still making money.
Was it that one?
No, it's this one. It's Mittal.
Okay. How do you think the rise of passive investing is impacting the asset management industry? That's a really good question. The answer is actually inconclusive, but the money. So just because less money is actively trying to beat the market doesn't make the market less efficient. That's a common misconception. It just means that fewer players are working on actively pricing assets. So just because more and more people, more and more funds are choosing to put their money in the passive basket, the finance industry is still fine with that. I mean, there's still fees being generated, there's still money being made. And then the few crowd that is active and actually good at that is still ensuring good asset pricing. And we haven't delved into this, but for example, with ETFs, you've got your market providers that always make sure that the basket of stocks and the underlying assets are priced correctly. So it's not a legitimate concern, in my opinion.
Yeah, no, I'd concur with that as well. Next question. How can someone start investing with a small amount of money? I think, look, we're going to sound a bit like a broken record here, but I think, again, just continually investing in the market over enough time will generate you a large return by the end. It's all about, I mean, there's a popular expression in finance, it's about time in the market rather than time in the market. So you just keep going for those marginal contributions. Eventually, over 30, 40, 50 years, you'll have a pretty good nest egg.
How can new investors mitigate risk associated with real estate investments? So there's a whole thing I didn't cover, or we didn't cover in the presentation, which are called REITs, real estate investment trusts. What's that? That's real buildings, real houses, corporate real estate, whatever, on an exchange traded. So similar to an ETF, you buy a share on the exchange, but you're actually investing in real estate. So if you're saying, oh, how can I mitigate real estate risk? I'm scared of buying at a high market price again. Then say if you were willing to purchase $1,000 worth of real estate, put $100 every month or $100 every year and average into the market. And of course, if you're investing in a little bit of stocks and a little bit of real estate, you'll be fine.
Okay, so next question is on bonds. I still can't understand, like, when interest rates on government bonds increase, how can a person holding the bonds suffer loss? Shouldn't it be the other way around?
Very good.
So this
Good question.
yeah, by the way, excellent questions, guys, really. Sorry, I've got to go all the way back. Yep. So basically the way this works is that, okay, let's go back to the early examples. So say the government issues what's called a power bond, right? So the yield to maturity, the amount of return is 5%, and the coupon rate is 5%. So all of your return is coming from the coupons. This will always be priced with a face value and the present value, the value paid today, are the exact same. So let's say interest rates are really, really good, which means the government only has to pay you 3%. There's very little risk in the market that the government needs to pay you for, or very little risk of them defaulting. If the risk of them defaulting gets higher, they have to compensate people by giving them more money as a coupon payment. Well, what does that mean for you? It means that your bond that's giving them 3%, so $30 a week, is significantly worse than the other person's bond, which is worth $60 a week, that earns $60 a week. Therefore, your bond is worth less. It's less desirable. Why would someone pay you $1,000? They could pay the government $1,000 and get a higher interest rate.
Just to stay on that, like the value of your asset has only changed in relation to new assets entering the market. The terms and conditions that you purchased are still the same. So the reason the value has gone down is just because other things are now more attractive, if that helps with that. But it's very hard to wrap your mind around. Once you get used to it, you'll understand it. I had the same question for a while. Do I go to do the next one as well? Yeah.
Yeah.
2 years back, I invested some of my savings in the stock market, and right now my stocks are hiked 75%. What should I do now? Should I sell them or should I wait for a little more? I'm totally confused.
Excellent job, by the way.
Yeah. First of all, congratulations on the returns. Look, I mean, I'd assume based off the average age of this call that you're quite young, and your best guess, as always, and it's going to sound like a broken record, if you have the market index ETF, MSCI World, S&P 500, whatever you like, maybe a little bit in one, a little bit in the other, then you'll be fine, because whatever happens in the market, you're not going to be worse off than the other participants, right? Because it's all about it's more about not losing than it is about winning. So if you're up 75% and you stay in the market goes up, you're good. Market goes down, you're still better off because everyone's down a bit. So if it goes up, you all go up. So your position relative where you are now, with your 75% gain, is secured.
Okay, so next question. In terms of significant market volatility, how do you adjust your investment strategies for stocks, bonds to protect your portfolio while still seeking growth opportunities? Can you provide a recent example where you applied these adjustments and the outcomes you observed? Well, look, personal level, guys, I just invest in the market. I'm an ETF guy, so sort of practicing what I preach. But look, if we're talking about significant volatility and significant market downturn, i.e., COVID-19, how would you adjust? It's very subjective. It's a term. It depends what level of risk you're willing to tolerate, how much you believe in the companies, or if you're invested in the market and the market's losing money, how long can you wait?
Call protection.
Yeah, if you wait long enough, if you're willing to wait long enough and you invest in the market, just wait. It will get better. The market will always continue growing because the market reflects the economy, and no economy will stay slow forever. Economies are almost always growing. Now, individual stocks is a bit more complicated. Obviously, we saw examples where individual stocks never came back, in which case, obviously, you'd be best off selling if you think, it's done and the future's over. But if you really do believe in a company and it's a stock you're 100% confident in, and wait, there's no rush. I mean, it just depends what level of risk you're willing to tolerate, or as previously mentioned, what your risk tolerance is.
I think that level of question might be better off if we do like a higher level, another higher level webinar on this. But I think we could expand into the world of derivatives and portfolio insurance, put call protection. So the question you're asking is essentially the question that everyone's asking every day. Their like institutional investors are asking and thinking, oh, what do I do? Because of course you don't know what's happening in the future. Do you take the rate right now? Do you protect? Do you sell? Do you keep, but you get some sort of insurance, some sort of contract? That's all something that can be expanded upon, but it's somewhat beyond the scope.
Yeah, look, super simple terms with regards to what Philip referred to. You could take out what's called a put option, which is just an option to sell a stock at a certain price. So this price is called a strike price. So if a stock you have is, I don't know, $100 and you want to make sure you get at least 80, you would buy a put option, you would pay someone money for the right to sell your stock to them for $80, and this would limit your loss to $20. So limit it from going down further. And again, we'd love to come back and do a seminar on this, and we sincerely hope you'd all tune into that. But yeah, it's a slightly bit more technical. If there's any more questions, please don't be shy. We're more than happy to answer them. We're not busy.
Any more questions, guys? Please ask. I think we are done, Elijah.
Excellent.
Well, we'll show the email.
No problem.
Yeah. So if last was just in case you need it, our respective emails, and of course the two quite useful resources.
And please don't be shy, guys. Like, if you have any questions at all, just absolutely feel free to email. We actually quite enjoy them. Gives us something to do.
Yeah. Not that we're busy now.
So should I proceed further?
Yeah, please.
Yeah. So as we are near the closing ceremony, before we depart, we would like to thank Alisha, Briggs, Phillips Reynolds, Dinesh Agarwal, Simran Sharma, Shalini Singh, Pradipta Mukherjee, and responsible members for making this webinar a success. We have shared a link in a group. We request you to give your valuable feedback. Once again, thank you everyone for joining. The webinar is now complete and you may now leave the meeting.
Thank you very
much,
Have a great night.
Phillips and Alicia, for giving this beautiful presentation and very informative.
Thank you very much, guys. Really appreciate you tuning in.
And sorry if I pronounce your name wrong.
It's okay.
No, you've done a great job. Thank you very much.
Yeah.
Thank you.
Have a great afternoon, guys.
Yeah. And good night.
Good night.
Too.
Yeah. And thank you guys for coming to this webinar, and thank you.